All right, let's get started. Greetings, happy Tuesday. Thank you so much for joining this Macro to Micro Power Hour, my guest captain interview series on Tuesdays and Thursday. I'm very fortunate to have some very smart folks who come on this show and share their perspective. Specifically, Jonathan Gibbons on Tuesdays. We do this because market structure matters and there's a lot moving in the world of macro to micro. So let me bring him in right here. There he is. All right, I've got closed captioning also on. Jonathan, happy Tuesday.
How's it going?
Wow, it's good. It quieted down a lot the past 2 days.
Yeah.
Okay,
very
one day.
very reflexive 200 points in the ES.
Yeah, but
Sunday
at the
low.
same, yeah, that was really dramatic. But at the same time, not such a surprise. I mean, the market, reaction to the GameStop, the Reddit, the retail, the whole thing. We're definitely going to talk about that and just volatility because that popped up like a rocket. It actually ended up being a third largest VIX spike in history of keeping that data. So that was a nice move on the day. And then it was, of course, squashed back down. But this is my whole theme for 2021, which is we're going to have this aura of volatility, fancy word for big swings, higher and then drops, higher than drops. But to me, that's all signs of distribution. And I think 2021 is going to be that kind of year. But you and I talked, of course, this weekend because the drama that was unfolding of the soap opera of Robin Hood and Melvin and Point 72 and Citadel, three of which raised money on Monday, all at the same time in order to shore up their capital and confidence, if you will. And it was kind of interesting because you and I did this show last Tuesday with the title Parabolas are trapped longs. And that leads to liquidation. That wasn't the sentiment from the Reddit, the WSB folks, the Wall Street Bets folks. They were gonna, hold and break the markets. It definitely hurt some hedge funds, but honestly, they won in the end, I would say. And then when that whole structure, it seemed, was quote unquote shut down, meaning we did our I did a webinar with you on Tuesday, did a video for clients and others on GameStop has no stops, meaning you got issues here where it's going to be very tough to sell. And that next morning on Wednesday, they stopped trading options at a number of platforms. And then Thursday stopped trading the underlying equity in a number of platforms. Outrage aside, it gave a whole bunch of time for that gamma unwind. It just started kind of quieting and coming down. And then, of course, Monday and today it has dropped precipitously. And they didn't make out like they thought they would. So we had the gamma squeeze and then we had the gamma unwind. I want to get your thoughts on how that might represent any sustained damage in the marketplace, because now they're saying, okay, event's over. It's not a long-term capital, kind of event. It's more, or a pandemic response, or layman. It's just, we had a major bout of stupidity on both sides, and now let's just go back to playing ball. What's your view on this? What has happened and where we are now? Because you have written a lot about it, and I have really valued that kind of insider take. And I also got some of my own, so I'd like to get your thoughts. Where are we?
Yeah. So, Ben Hunt said something. He was on a podcast on Sunday night, and he was talking about if it had been anybody else instead of Robin Hood, then they probably would have been the shop would have been raided, like if it was actual wirehouse. I thought it was a really interesting point, because I hadn't thought about it like that. Robinhood, I'd said last week and kind of thinking about it over the weekend, are they systemically important where they're going to get, some assistance here? Because they were in trouble, right? Like their T minus, T plus, for their DTCC calls for margin were blown up. They were in trouble. And that was the sole reason that they shut everybody off because they had to shut everybody off. And, they were, Ben had made a point that they had a pretty sizable balance sheet. They were getting pretty decent. I mean, they have 14 million people using the app, albeit it's a lot of small lots. This decent size balance sheet. And they had been, but the problem was that they had actually, by proxy of the application itself succeeded, right? They were selling a bunch of stuff that they didn't even really mathematically deduce what the ramifications were, or if you have a value at risk, so that VAR statement, and then your skew. If these things start, if you're selling a bunch of calls, right, and they start running against you in such a way, you got to find the actual underlying security in all these small lots that have been buying 100 calls for that's a fair statement about Ben, that they would have been ready. I'll touch on that in a second.
Okay.
So effectively, like they were successful in what they created, right? And so it took off, but they didn't do the math, right? So the risk management side, it got away from them. And so this thing blew up. And so they were exposed, right? Totally out in the wind. Their investors came to the plate with more money than they'd raised in 8 years over the weekend, 3.4 billion. And it wasn't just over the weekend, they did $1 billion last week, and then 3.4 billion over total, so 2.4 over the weekend. And that's sheer for balance sheet, shoring up, right? So it was a huge statistic, but it was only for margin call, right? So this was a mess. They had to punch it, stop it. It had spilled. It caused impacts to other people. These things, but these are interesting things that you said, what's the long-term impacts of this or what have you? I think if you look back at like Lehman, right, it wasn't just instantaneous, bear, then you got some knock-on things. This goes on for a little while. It's more of an issue of a bigger picture of what's going on than just this specific thing. So did they shore them up or did they not shore them up? I told you over the weekend, I thought it was 50-50. They get the funding. I said it was billions, not billion, not one. And that was correct. It was a total 3.4, right? So it was billions that they had to come up with. They did. And, so now they're sitting there, and that situation is somewhat settled. They shut everybody off, which they were going to do. And they did that. They were in a quandary. I don't think that they would napalm their brand on purpose, right? Like, and they napalmed their brand when they shut everybody off. And now they crushed them all and, blew everybody out the tailpipe, through the other side. So the funds did. And so, Citadel didn't get hurt by this. Citadel's buying the order flow. They're front running on the way up and they're front running on the way down. So Citadel's not injured.
Well, they got hurt initially, but they can quickly recover because they're front running on the way up and on the way down.
Well, I wonder if Citadel was hurt at all, right? Like Citadel was probably holding the bag on they probably squeezed here. If you're sitting there, I got a ton of money, like tons and tons of capital. And then I see Robinhood take a shot and I see Melvin take a shot, right? I'm going to shore up Melvin, right? Because Melvin's the guy that everybody follows on Wall Street. So he was going to get a bailout, right? And everybody's going to come back to him, which you had talked about this weekend. We had talked about that a little bit in more detail. And so I think that like this was infecting a lot of different things. Things got shored up, they froze it. And I think Robinhood's investors ponied up because they had everybody, after I thought about it over the weekend, because one thing that stood out to me that this may not stick on Monday was that we had puts like, on, in the money, deep in the money by the time that Friday came around, they just weren't paying. And, it wasn't playing out. So it didn't feel like it was going to stick, just honestly, like without going into a lot of details. So I figured it might be reflexive when it comes back on Monday. It's a separate subject. We'll talk about that in a minute. But like Robinhood itself, the investors at Robinhood had the most to lose because they are almost at IPO, right? There's billions of dollars tied up in this thing. And there's still probably, even if they lose 4 million people trading, there's still 10 million people trading on that app. Mm-hmm. So I think that it was more of the investors came to the table to save their own investment rather than it was, a Wall Street bailout. And people made phone calls and so forth. And this is an issue, right? We need to figure this out quickly so that it doesn't spill into all these different things. So all these kind of things like this can always go either way. That's why I said it's like 50-50. If it spills, it's going to be bad. If it doesn't spill and they shore it up, then people are going to get hurt. I think that one of the things that happens now is that the people that were buying calls, You know, that whole structure of the call buying impact, and I mentioned this on one of the threads we were talking to earlier, that might be paused. I don't want to say it's shut off. I don't, you know, people still come back to the table, but how many people got wiped out, and is that going to continue to be a component here in the very short to medium term as it has been, right? Or is that like, you know, people, they're just body bags getting drug out on this GameStop deal, AMC, same thing, you know, but I still saw some single names like getting chased around a little bit, but there's definitely some collateral damage on this that I think could impact that piece of it. I think there was a lot of people that were, let me address the Ben thing. People, if I knew, if you were a dealer and I knew you were bust, right, then I'm out. Like, and everybody would have taken their business out. And so there would have been a run on that dealer. Like, and that, so Robinhood was bust, right? But because they're kind of like the only guy doing what they're doing in that scale, they kind of got salvaged almost by default, right? And I think that that's a fair statement, that it was always the investors that were going to come to the table and think it all the way through. It makes sense. So but having said that, then you got to kind of address Robinhood's business model. Is that still going to be something that works here? Because you saw Public come out this weekend on Monday. They came out Monday morning, Public, the other app, and they said, we're not going to sell order flow anymore. We're not going to sell you, right? And they're like a direct competitor, you know, trying to get in that same market share, you know, getting people on there for free and having to pay for order flow. So they said they are not going to do it. Then there's regulatory Senate hearings already set up for Vlad. He's already set up in 2 weeks. He's like 17th or 18th. He's in front of the Senate and they're talking about order flow, you know. And so this whole gambit of aggregating users for order flow will directly impact the ability to, you know, continue to see these kind of gamma squeezes, if that is in any way kind of changed, if anything changes with the order flow, paying for order flow component. And so I think that has a market impact in the medium to long term that would be pretty substantive, because that's been not the single issue going on, but it's been a big staple point. You've got the short vol trade, you've got ETFs and the passive indexation, so passive flows, right? And you got share buybacks and tax stuff. So the tax stuff's out, passive stuff's still in, short vol still in, the gamma stuffs could be out, right? You're losing legs or pillars of this whole thing. And I think that, you know, that's not necessarily, that's why I say, I don't think that when they shored up Robinhood, I don't know that it necessarily, it solved that kind of spillage issue, right, with the derivatives and so forth that they had out there, because they all like shored it up. But Robinhood isn't using any of that money for growth. They're using all that money for, you know, collateral. So that salvaged the business. That's not. And now they've got a comms, like PR comms person job post out there that Morning Brew threw out there trolling them. I mean, they're it's a mess. I think they'll still get to IPO and you know, they're too big, you know, too big to fail in their little niche. But is that business model now viable in the long term? I don't know, because like they may, you know, one regulatory thing, so there'll be some lobbyist deals hooked up on that for sure. I think so. I think reflex. People were positioned, you know, over the weekend, like long vol. The one thing I saw, and I mentioned this to people at the end of last week, and then I mentioned this to somebody on Friday night. What I was seeing was people were shorting vol hard on the spikes. They were trying to contain this thing, and so that they can maybe reposition themselves on Thursday and Friday. That's what I saw, and I was like, well, we'll see if it works or not. If it does play right, then you've got a situation where, you know, you held the line for yourselves on your end as a hedge fund or an institution or whatever, and the pensions, right, all that kind of positioning. They did hold that line going into the weekend. On Sunday night, it was a staring at it. I mean, these things are never exacts, right? Like, you talk about probabilistic situations. Sunday night, it was looking ugly, right? I mean, if you knew that they were going to get the money, if you knew that it wasn't going to spill over, maybe reposition.
Yeah, but they took money from, you know, Cohen and Griffin, which in Peter's comment, you know, this is taking capital from two. He's got some choice words, but point is, what kind of deal did the devil have to strike to get that?
Well, you got some. Oh, are you talking about Melvin? Are you talking about Melvin?
No, I'm talking about Robinhood in order to to save themselves.
Robinhood took money from Rivet. So their investors, Anderson Horowitz, a ton of the people that were in the late stages came in with the 2.4 over the weekend. There's probably some mixed in people with that. It's a convertible note for shares later. And then you got a line that was issued and they're trying to find some more lines. So this is a bunch of different players. A lot of their investors came in. Melvin
in chat is saying 2 times all prior funding. What's that?
100%.
Okay.
Yeah, 100%. So 3.4 billion. And so they had this is like larger amount of money in this like few days than they have raised overall, right? So I don't know the exact number that they raised overall, right?
John's
so
saying they previously raised 1.7
billion.
So they doubled that. So
yeah, for margin, right? So for their margin call, that means that. So and they had a good balance sheet. That tells you how bad it was.
Okay, so we don't obviously we're kind of like skirting around the edges here. So Robinhood didn't go under. They raised twice their prior funding, and they took it from and I'm sure Cohen and Griffin and such are sitting pretty in terms, but everyone looks to be salvaged again. They're not too worried about the retail, but obviously I'm talking about on the hedge fund side and the Robinhood side. And obviously that was kind of needed as the accounts were slipping dramatically, actually not slipping, they were racing dramatically to Webull and some other platforms, but the commission-free model and Webull is China owned, so that's not advantageous for the US. So the point is what happened quickly to save the system, and then this hyper bounce off of this standard deviation move that obviously was dramatic in GME. It had to come down at some point, right? And when they stop providing the liquidity, and traders can't stay with this huge gamma and short squeeze, it just floats back down to earth. And it's convenient that Citadel also has, let's see, mark-to-market exemption, which gives a 7-day window to cover naked shorts. So they really had they could wait it out. Robinhood maybe not so much, T2.
Yeah,
but they could wait it out.
Yeah, well, I mean, they threw it back. I don't know exactly how it shook out. It probably got thrown back to be like, go raise the money, right? And if you think about where the money came from, it was the investors that were like, no, we're not going to let this go under at this stage, right? And so now, but now you go back to they didn't have models in place for the way that they were selling, right? And so you got a person, right? And you got a person that's buying 100 10-cent calls, right? Like that, there's no commission on that trade. Historically, that trade would have cost $150, I don't know, something like that. And they got $100 in their account, and that goes from $100 in their account to 100,000 in their account, right? And then you got all the shares that are associated with that. These models, like somebody's got to be at home modeling this the way that they were doing this, but they just kept getting more people. And then that's where I say, like, it wasn't a bug. This was a feature of Robinhood that caused the situation. And now that feature, which is, was the single stock gamma piece, is going to be taken out. So set that aside. So take that out of the equation now, and you set that aside. Go to look at Robinhood as a whole. Like, they publish the top 100 stocks that people are trading. You come into the app, you see what other people are trading. They encourage you to trade certain things that other people are trading. All the UIs just swipe up so you can place an order real quickly, like you do with anything else. So everything with user interface, everything the way they design it is so that you are aggregated with others in the same trade. Why would they want to do that? Because they take the trade as a whole, right? More people that they have in that same trade, the easier it is to sell, the more margin they get, the better the deal. And so that whole dynamic of their entire platform was built to, right, aggregate order flow. Then when okay, that's fine on securities basis, not really a big deal, single stocks. The options, different ball of wax. You got all these options contracts being traded with people that are like on pennies. And these things are flying all over the place now because of the gamma squeezes that are taking place. I wonder if the more long-term effect of the situation is that, and yeah, they're just attacking the single stocks that are squeezed, right?
This is a big deal. It was funny because I was reading an article. Nomura, is saying nobody stress tests their books to experience a 13 standard deviation move in this, what I call the factor rotation play, right? Crowded longs versus high short interest, and the short interest factor alone saw a 10 standard deviation move. And that's not even including what happened with GameStop. That was a 15 standard deviation move
To my
on
point.
Friday.
Yeah, to my point. That's exactly my point. They didn't think about or model the upside ski, just the ski. They didn't model the value at risk and then continue to be readjusting it on a constant basis as people were, selling. So it's just one of those situations where I don't think it was intentional. I think that their plan was socialized, trading. Order flow is cheaper for everybody in that basis. They do, okay, we'll deal with options. It's great, it's growing. And we get this phenomenon, it's a part of the market too. It's not the only thing that's impacted the market. Just want to make sure we say that it's not the only thing. You got passive ETF indexation, you got passive flow, you've got buybacks, you got taxes, you got a lot of different short vol trade, you got a lot of different things that have impacted this market. But this was a big piece of it, especially the last 6 to 8 months. And now this piece is frozen for a little bit because these people got smoked. And now these guys have to really rethink the way that they're doing this.
But they haven't really. I mean, everyone's talking about hedge funds degrossing because they were forced to, right? Risk managers all over were tapping, the PMs on the shoulder and de-risking. But this is still, fund leverage remains very elevated.
Oh, no, 100%. So if you think about it,
1 week does not, a solution make. This is still broken.
Oh, no, 100%. So this is still like rolling around. What I'm saying is like the whole single stock piece. I don't, pushing that around, people buying that order flow from that. This is going to probably, let's just say it's like got a leg knocked out from under it. So it may not carry as much weight going forward as it has been, which means now we're kind of towards this other piece. Well, what do we have left that's carrying things forward now that leg's knocked out, right? And I think that what you saw Sunday night, Monday, and today is reflexive, totally reflexive. People were short. All right, that's settled up, squeeze, right? And everybody's taking those positions off because you saw massive puts in the ETF buying on Thursday and Friday, kind of hedging out against this. They take that off. VIX gets crushed, right? And it comes back down. But the interesting thing is the dollar didn't budge.
Oh yeah,
right?
We're going to talk about the dollar. That's in a
dollar
sweet
kept
spot.
going, and then VIX is a higher low, and the indexes are still here. So we're kind of towards the tail end of this thing at this point, like where these legs keep getting knocked out. The tax piece is out, so there's the $1 trillion coming in. But like I think that this is a bigger impact in our conversation of the markets. Of will this single stock gamma options component be kind of at 25% of what it was last week? And now I think that's pretty substantive component when you look back at what's been going on. I saw in the system a significant change in the quantity of some of those single stock names, not just these ones that people are talking about. The options volume that I saw the last couple of days was totally different than what I have seen in the last few months.
That's what I actually wanted to bring up as well. It's getting more fragile. And one thing I have noticed, and I have noticed and I have commented that EPS has been very strong, but they have weakened or sold off, not, drastically, but enough to notice that they're not holding the strength post EPS. So they're running up into earnings, and then they're not disappointing. They've been strong. This is just a chart that shows that the reaction to the first 200 companies in the S&P that have reported, they've beat by 19%, and yet the market has not rewarded strength, and it continues to be, I would say, a sign of some weakness. But when you're talking about the VIX, obviously we talked about this on Tuesday. I saw this VIX structure coming up. It just from a pure technical standpoint, and some other intermarket, reads that we were going to have a volatility event, and we did. But even then, even after it has retraced, which is normal, right? Because it's made to, be shorted, if you will. It's clear that exposure, I got this, just retweeted this earlier, remains severely underhedged. Still, as last week's market stress triggered aggressive hedging flows, evident involves few dynamics. Now those same hedges getting puked, fueling reflexive vol crush past 2 days, and this vulnerable dynamic will persist. So this is really messy and noisy, but the point is that's what feels like the market will be in 2021, this aura of volatility that's going to, at some point, I would say, kind of soften the resolve of the short vol regime. And then if you combine that with a little dollar pop, which you and I have both seen rounding the corner and coming back up very nicely, I think we've we're still looking for that recipe of distribution.
Yeah, 100%, right? 100%. What's the question? If obviously there was issues. I can't see the whole thing. Was it retail
it says, sorry, if the options looked different, does that suggest that what was explained for months as retail option buying, the single stop gamma option, call fanatics, may have been hedge funds masquerading their flows in small lots to appear to be retail?
Or yes, or I should say, seeing where that's going, front running it because you're paying for the flow, and then gassing it up.
Yeah.
Because right, and so I think probably latter more than just the former, and I think that's exactly what happened. So now that's going to subside, so to speak, right? Because those people are like, they got smoked, right?
Well, the funny thing is, Lily, who you introduced me to, and she has been on this, the option flow and size and such in her writing, and she'll be on Thursday, which is really cool. I want to get her take on the GameStop and also the silver flow. I didn't need any flow to know that silver was going to come back down. That was just, that was too easy. But, but honestly, we have seen this repeatedly where they're just gunning strong call buying. And then that obviously the wind was taken out of their sails last week. Wednesday morning, they couldn't do that anymore, right? It was severely limited. And then Thursday, even the stock was severely limited. And then they made restrictions, really high restrictions and high margin to do the short squeeze candidates. So it kind of came back down to earth. There's no question. And then it just fell to earth. But I have seen this play out in the whole single stock gamma option flow for EV, and it doesn't matter. It just goes sector to sector to sector, and you can see tens of thousands, hundreds of thousands of calls come in. And I think that's the question, really, who is it? Are we really talking about a social media mob of call buyers? Or are we talking about hedge funds masquerading as call buyers?
I definitely think that you've got the purchasing order flow, front running order flow, and then you can see these things moving that direction. If you have a bulk of participants that are only one-sided moving that direction, and there's 14 million accounts at Robinhood, something like that, plus all these other ones that were going on, these offshoot little ones that are here and there, that can add up. So I don't believe that, SoftBank, that's a whole conversation about Chamath taking on Robinhood, right? And and sandbagging them and everything else in the last week. But so if you think about that, it's like, if I see the fuse lit, then I just I'm throwing gas down the pipe on it, and then you're gonna make a big fire. I definitely think that you're right? I definitely think there's some merit to the hedge funds, not necessarily masquerading as small players, but seeing the exploitation in the system called cheesing, right? We've talked about this a bunch.
But before you talk about the cheesing,
gamified.
Yeah, so you talk about the cheesing and explain that a little bit, but the Chamath pitch of SoFi, that's his target for his SPAC. SoftBank, which has already said, they're guilty as charged prior, right? And then they were going to get out of that business, and they were just going to invest in like lemonade or something. I forgot, but they tried to soften their effect of what they had been doing because it was found out. They were maybe first into creating that market. It almost seemed. Now Chamath and even Elon Musk, who game stonk, and now he's like, I'm going to take a break from Twitter. They're making too much. They're causing some damage here and talking their book. So that's
what I would say is like, you've got, if you're doing something like this and you want to keep doing it, you're not going to come out and like beat your chest, right? You're going to keep doing it just strategically. It's if I've got something that works and I've got a gambit and I can keep running this play over and over and over again, I'm just going to go cheese each one of these stocks, which means I'm going to exploit a flaw in the existing system,
Yep.
especially in multiplayer games. It's a video game terminology, right? Like, you know, so if I cheese that and these guys start buying these calls, push that move, so like $20 million, flip something on GameStop, we throw the gas on and it's electric. That's something I can keep doing over and over and over again, because there's a bunch of these stocks. Problem is, everybody started beating their chest and made a big scene of it, right? And so now it's over, right? Because they've readjusted their models, right? All these, so Robinhood will take the licks. They will go readjust the VAR model. They will go readjust their SKU. Everybody's going to readjust this, the funds, Citadel, everybody's readjusting, knowing that this is going there. The puts, right? As soon as that standard deviation event happens, they reprice and reset the puts so that they, you know, they protect themselves for the downside risk of selling those puts. So you know, it's, you know, you look at you don't say, okay, it's done because these guys, like, you know, they all got blown out. It's done because they reset the table.
But how do the prime dealer desks really have peace of mind that this isn't going to crop up again?
Yeah, 100%.
The settlement network, it has been compromised with GameStop and the rest of the short squeeze candidates. You know, whether they were used or abused. I'm talking about the Reddit crowd, or they might have just kind of triggered it. They served as a signal, and then everyone jumped on. I mean, it was, the whole thing is fascinating from a psychology standpoint. But then what are the prime dealer desks now? How do they deal with that?
Well, I don't think they were ever worried about, like, they were worried about Robinhood after they realized, like, Robinhood, you know, I'm just, you know, 2 cents here. Robinhood is like, what's the exposure? And they probably, you know, I don't know. What do you mean you don't know, right? Like, and here we're going to help you try and figure it out so you can come up with $3.4 billion, like in 48 hours, right? Like, that's DTCC, like that type of thing that spooks people, right? But they're not going anywhere because, you know, they got salvaged for the situation. So they're going to change the way they're doing things so as not to get in that situation going further. I think the impact to the dealers, you got to look at Melvin, and you got to go look at the Melvin, who impacts about 10, 15 other funds that are, you know, from the same tree of network, and everybody wants to emulate Gabe. And you look at the like how badly they were hurt by the situation, and what does that mean for, like, pension funds and other stuff like that. That's what spooked. And then what are the derivatives that people had in their books that had to be liquidated? Where is that shakeout? Usually these things are like shocks and, like, shake the system. We're already rehypothecated as it is. The ETFs are already a rehypothecation of the market. We've talked about, people have been talking about this for 4 or 5 years now, about how fragile the situation is. I think that it will help people will, right, try and readjust themselves to an extent, but how much can you readjust in an environment where now options are greater than the market, and these apps aren't going away, right, overall, and people will keep trading, and so it's kind of like a bunch of different dynamics at the same time. So it's very hard to say. You know, the thing that I really thought about this weekend was passive and pensions. If passive or pensions, like, get hit by this, that's where I was really, when we talked this week, and that's where I was thinking that really things could spin out of control. If the passive is impacted and decision making on the passive programs is impacted, or pensions, you know, and so pensions were hit with Melvin. These guys, like, took, what are they down 53% in January? Right? Like, that's not an easy bogey to make up. So, like, you know, what was the impact of that? Does anybody know? What did they hold? Does anybody know? You know, we'll just have to see.
All right. So a few comments in chat. I don't know the answer to some of the questions at all, although Jonathan is just tweeting, I should say, including a blog where Robinhood is blaming the T+2 settlement and saying the solution is real-time settlement.
Okay. Like, I mean, you know, the Robinhood's coming out saying that it should all settle real instantaneously. Is that effectively? I haven't read it. I don't know.
Yep, that's what he just put in there.
Instead of the T. So
would a better VAR system, but
yeah, I mean, like, we're talking about like, the system outkicked the coverage. So the system, what they were doing and the way they were structuring things pushed it past what anything was built to do. And somebody had said something like, is the system really built for the way that things are going down right now? I think it's definitely an adjustment. People will make adjustments, but will regulatory entities and the backstops of the exchange, right? Will they make adjustments so quickly? No, it's gonna be slow. Real slow. It's always slow. Obviously wouldn't address systemic increases in optional. Yeah, look, it's the system is past the way that they were functioning, the way they are functioning with people trading such vast amount of options contracts with no fee, no tax, no trading tax, no commissions at all, right? Those volumes just I can trade so many more for $300. Unless something changes on that, then all of the back end is going to have to be modified, right?
Yeah, this is a question too.
They're throttling everything, right? Like, because look,
the word. We could
they're
see this.
throttling it.
They were throttling not only many brokerage platforms were down or slow, but down on Monday and Wednesday when they throttled the option and or stock liquidity on these names. That was fascinating to see. And then boom, VIX just kept climbing and climbing and climbing as they sold off stuff that mattered because of what was happening with the short squeeze and the liquidity issues. So, I've had one insider text me saying, given the volume, there's no way Robinhood can deal with flow and do margining on their own clients correctly. Robinhood is faking it until Robinhood makes it.
It's a quantitative model that has to be built, like in their, if you go look at their hire sheets and stuff like that, they're, hiring customer support people and marketing, they grew very fast. And so, it made sense. Everybody's participating. Nobody expected COVID to happen. I'm not sure this was, like I said, it's not intentional. I just think they're going to have to. I just think they're going to have to model out something. Maybe they are part of creating the solution for automation as it relates to a derivatives-based market rather than a securities-based market. I don't know. Nobody's done it yet, but we continue to evolve as a market, so who knows? So I'd say but
they're evolving toward blockchain and crypto settlement so much faster because of this fiasco. It feels, and I'm not, by the way, a raging bull on either. Yeah. I'm just saying the sentiment seems to be we have to fix this real time, quote unquote. We couldn't do it otherwise without a massive change and upgrade. But
it was, like I said, it's a feature. It was a feature. It wasn't a bug. This was a feature, right? Everybody gets put into the same things, and then everybody's sharing information and cheesing the system for that app. And cheesing this system was buying deep out of the money calls for nickels and pennies and 50 cents and stuff like that.
But it wasn't the buying that blew them up. It was the folks that were selling the calls, and then all of a sudden they were. They
had to buy them first.
No, but I'm talking about. This is just the crazy risk in those who were, shorting GameStop and others. I'm talking about selling the calls that then opened up. What was the example? 3 cents to $1.20.
Oh yeah.
Okay, I'm talking that kind of, yes.
Yeah.
No, that's exactly what I'm talking about. And that happened. I know a few traders also that sell premium in January, and it's their base mode of operation, and they're hurting, and they weren't even involved in the short squeeze candidates. So even the big tech ones that they like and play all the time.
This stuff so it's a shake. It's a total shake of the whole options construct.
A hard purge. But I don't think so. That's why I'm kind of asking that question, because we talked about GameStop and this dynamic. And the insiders had at first this breathtaking moment of pause where they're like, oh my God, that 3 cent option just went to $1.20. We have to cover that. And Robinhood didn't have the collateral, and all of them did their raise. And so it looks fine again to the market because price, the indices popped up again, which they do so often. And everyone is now just complacent again. And yet I see a lot of flow coming in. February has a lot more put action, expecting something.
I think this was reflexive, right? Like, so, you know, a lot of stuff that takes place, there was some stuff about rebalancing, and there's a chart. I want to say, did Jonathan share it in the thread with us? And it was the, you know, when long shorts rebalance, you know, is usually followed by a large rally. A bunch of people shared it over the weekend.
Yes. Yep.
It's just like a historical kind of comparative we're having.
Yeah, but that was only the past 2 years.
I think that's what I'm saying. I think, like, you can look at these kind of analogs and fractals and be like, if this then that, and, you know, equals Z, so X plus Y equals Z. This is like created not because people were rebalancing because of positional stuff. This was just a option bomb drop because of a broker it's like kind of way out in Vanguard on the curve, doing some speculative things themselves with the way they're operating. So I don't know that anything changed per se. I don't know that the liquidity situation is any different. Maybe it's even more dicey than it was. The dollar's still bid, and you're sitting there, and was this just reflexive? And
Okay.
I mean, we're up 200 ES points from covering, right? You went bidless to no sell, and that's just people covering. So how thin is the market? And I think the market's pretty thin comparatively, especially as we keep losing, you know, different sources of people in the game. And that's just looking at very big picture.
Well, there are a few things, and Peter makes a good point. Hedge fund speculators are beginning to understand the power of technology, and the internet has flattened the information edge that used to be smart money. So unfortunately, in the case of silver, I think they did not pick on someone their own size. We got to talk about that. That was just
total mistake.
I don't know if they really were trying to squeeze silver, but that was just absolutely guaranteed to pop and drop. It played out exactly into the hands, right, of who was it that Cohen bought a whole bunch of silver last week on this signal, and is already the 5th largest holder of SLV, the paper fund. So the whole thing just really looked or smacked of manipulation. I can't even tell what's real and what's fake, and not only in the Reddit threads, but in the manipulation, because the moves are so outsized, which just shows me that it's getting that aura of volatility, not just in individual you know, ETFs, which are pretty large and not easy to move. But forget the commodity of silver, which is really large. And anyway,
retail's not moving silver.
Retail's not at all. But talk a little bit about, you had mentioned something this weekend, and I know everything's quote unquote calm now, but 2 things. You had said, like MBS, the 2008, 2006 through 8 kind of situation where everything is fine, but you're talking about rehypothecating the mortgage, and the same type of mirror potential with the Robinhood, not really Robinhood, but that collateral damage that they can't really recover from. They're trying to look like they are, and maybe they can to a degree. You know, shareholders get diluted. Maybe there's going to be a new CEO, but ultimately the ripple effects that actually now say, ooh, we have to be careful doing these big shorts. And maybe the VIX trade is absolutely a sign of, you know, that insecurity, you know, in that particular model. So what that statement you wrote about MBS and rehypothecating mortgages, explain to me, how is that potentially similar?
So, you know, what happened at that, if you study that back in the day, there was the same mortgage was, you know, kind of encumbered to 5 different tranches of different towers of MBS, right? So it's all fine when everybody's taking a pie of something that goes up. It's not fine when there's only one to cover 5. And that was like multiply. I mean, this is very simple, like example, and it's all over the place. And it, you know, thing's not sustainable, and it's kind of who's going to get out first, right? Because this doesn't work at all. And what are we holding, right? I don't even hold, and who's holding the real thing, and, you know, what is it performing, et cetera. So that's a whole different.
And there was a run on the real thing.
No, 100%.
Over the weekend. Yeah, there was a huge run on the physical silver, just because. They're also, by the way, they're rabid bulls anyway, so they want to hoard. It made perfect sense to me that they would go after the physical.
Well, if you look at like what I was referring to this weekend with the MBS is like you've got Robinhood selling calls they don't have the shares for, right? And you got them, and that could be for silver, it could be for anything, and their model's not built for that. But the growth that they're experiencing, and look, nothing goes bad, market doesn't go down, it's fine, everything shakes out. That whole kind of back room conversation, yeah, go ahead and do more, it makes sense, it's good for business, that led to the MBS thing. Same kind of thing leads to here with selling the options that are just far outseating the ability to deliver the securities in the case of something going wrong. And if you're not readjusting those models in the kind of time frame that they're talking about, I don't even think that's really even something that probably makes sense to even tackle, right? Because you shouldn't be selling them in that kind of capacity to begin with, right? Because it's like rehypothecating something that it's not there, right? Maybe the market doesn't even have it all. I mean, it's so interesting. We all think that this is all like, definitely there's a system back there somewhere that's got all this catalog, right? And you look across multiple different businesses and they all it's like we're working all from the same database. It's just not how it works. These guys are running their own database. They're clearing through the clearinghouse. The clearinghouses are there, but they're doing their own stuff. And so is all their stuff lined up one-to-one? Is it, how many shares are being sold? That rehypothecation that I'm talking about gets into the system that's already rehypothecated. So the system is already rehypothecated, which we know about with ETFs being rehypothecated. So this is just layers of stuff being sold for the spread on top of layers from stuff being sold for the thread. And it's all fine until it's not fine and it breaks. And it broke, and everybody was really concerned about 3% drop. We were 3% down from the all-time highs here on Saturday, or 4, right? And boy, it was like, the whole world was going to end on Saturday. And why? Because everybody knows how rehypothecated the thing is and how infected this stuff can be. And so I think that,
I think they were also forced to sell. They were forced to sell some stuff that actually had been used as collateral, right? The apples and such. So it made a lot of sense to me that they would sell stuff that matters to cover the stuff that was hurting, that doesn't matter normally. But
100%.
But the liquidity stuff is still all based on this ability for retail and hedge funds alike to weaponize gamma. I mean, this whole phenomenon in 2021, 2020, excuse me, I forget, we're in a new year, is about, weaponizing gamma. The SoftBank, I mean, we've got so many financial instruments, whether it's, lower for longer in our yields, or we've got, what do you call it? Suppressing also the dollar, actually devaluing the dollar. And then we've got this, gamma squeeze that has just been a phenomenal tool for profits. Not to mention liquidity. I mean, it does seem that folks are still going to be on the side of, we're pulling earnings forward. We've got, stimulus. We've got the Fed backdrop. We have all kinds of tools of low interest rates, and this millennial crop. They're going to keep real estate nice. Fed can come in and do yield curve control if it, if it gets too weak or too strong, right? So really, what's the downside here? And you and I have talked about the dollar and volatility. When they go to hedge, what pops up? VIX and the dollar. VIX obviously doesn't move like Jagger, but it's definitely been firm, and it's rounding the corner, and it was very strong into today, even after the whole gamma unwind of these short squeezes. So VIX and the dollar, they can absolutely reset the market forces. They're stronger, let's put it this way, than Reddit. They're stronger even than Cohen. Oh, yeah. So we're still looking at causes that would create instability. But until then, this gamma squeeze seems to be, the device du jour, and SPACs, of course. This is still the low inflation play for investment management and retail alike, to jump on the bandwagon of the blank check IPO. That is speculative, and very, very successful to a lot of P&L. And I gotta, you know, I gotta give it to them. We're finding new ways to make money in this speculative excess. It keeps coming. um,
It's a mania, right? This is a mania, and it's been driven by many different legs of things. I think that's what I would say, and we're losing legs of this that have been carrying it, but we're not losing all of them.
nope.
And so,
And you did mention too, you said specifically passive indexing is still
but that's
an elephant, no question.
it's an elephant, so short vol, right?
And short vol.
Yeah, and so passive is the biggest element and has been. And Mike Green does the best work on that. I'm not even gonna try and go
Oh yeah,
dig through
yeah.
it right now. Okay,
Yeah.
everybody needs to check out his stuff with Grant Williams from about a month and a half ago, 2 months ago, something to that effect. And he breaks down the
Chris
passive
Cole
thing.
and Mike Green are the two podcasts that most had me shiver.
Yeah.
No
Mike Green, like Chris is like definitely in the vol kind of structure and the bonds, especially like, you know, the bond problems and the pension liability problems, and Mike the passive piece. But like the passive piece is there until it isn't. And a lot of the stuff that we're all doing with the ETFs and, you know, even like Stash and Acorns, like, so you set Robinhood aside, Robinhood being a singular situation here. And that's the way I was really thinking about it this weekend, is you have like 4 or 5 different seats at the table, and they all have been coming in at one time or the other. You know, your Trump's tax cuts, that's gone. Now it's tax raises and, you know, unfriendly business environment. Then you've got, so that's gone. You've got the gamma stuff, which is going to be kind of, now that's going to be resituated. I don't know that that's going to be the same gambit that it was up until last week. That's going to settle in. Maybe it's something different version of itself, but probably not going to have the impact it had. Then you've got the stock buybacks that were there. Those are not happening right now. And so you've got what left at the table that's been driving a lot of this to get to this mania state. And we're at the mania state. And so these people, you know, this is stuff that's in a mania, but we're in a mania in most anything. And I mean, you know, things are coming down. You got to have some, ultimately things really end when the buying is, there's just nobody left, right? And then it's the selling, and it's not there.
Well,
study manias and bubbles, and
then we'll be doing another webinar, which will be called Parabolas Equal Trapped Longs.
100%, yeah. And so I think, you know, when is that? Can you put a pin on it or whatever? You just got to look for different signals. Like, there was a probability that this could ignite the selling and would put a pause on the buying. And Mike Green makes a point that it doesn't even need passive to start selling. If they just don't buy, because they're a huge part of the bid, not that they have to start selling, but if they just don't buy, and the impact it has is dramatic.
Yeah, but they're forced to buy in many cases.
Well, yeah, until they're not. Right. And so if you look
although they did change that last year. They were supposed to do their quarterly, and they said, yeah, we're going to wait.
Well, so the point being, right, like there's no way to put a pen on it other than the fact that you got to look at where people are positioning. And there's just, what are people hedging with anymore either? Like
volatility and dollar.
That's it. So like we're trapping ourselves into like, there's like nobody left. It's like a giant game of like momentum poker, and there's like 3 players left. Right, you got.
I got to tell you that though, it is poker, very
right. Dollar VIX passive versus dollar in the VIX versus passive.
No, not passive. I would say the growth value rotation is still front and center. I still am, since September 4th, this growth to value, which is not just commodities over stocks for 2021, but literally this rotation, this factor rotation that is causing all these disturbances in the force, like what we had the past few weeks with these short squeezes, separate from the gamma squeeze. Just so happened that GameStop was a perfect storm of both short squeeze and gamma squeeze. But for me, I'm seeing that the disturbance that's come in from the growth to value rotation, it's not done. First and foremost, the de-risking is not done. So I'm always, as you know, my indicators and my stock bond volatility and the macro is the story. And I use the data to kind of try and create a time frame. So volatility erupted last week. That was totally easy to see. When does it come next? I don't know. I'm looking at February as they're coming in and expecting something to happen in February. You can see the flows.
You can see it, and you have higher flows on vol didn't go out down this spike yesterday and today. The flows remain. It's sitting there at a higher low. Even if it fills the full FEG on the charts, it's still going to be at a higher low. And you may have higher highs in the market. You saw 200-point reflexive move in the market. You had what, 7-8% in the Russell in 36 hours. These aren't that's reflexivity. That's not like, it's, coast is clear. This is reflexive. Is this continue higher? I think that you got to watch the bid and vol, watch the bid and the dollar, and you're going to see because you got to see what the options market looks like in the next week or so. I think you're dead on it. I don't know that, we said that, like the one chart that said like, it's like an average of 15 or 14% and a move after the funds rebalance in the last couple of years. We did 8% in 36 hours or something like that. So it's like everything's moving a lot faster, right? And so it's getting dicier and dicier. To your first point, when you first got on the call, it is shaking.
So
right? This is shaking.
Here's the money quote. This is the money quote. It's all demand for implied, referring to volatility, but no supply.
Mm-hmm.
A near endless need for skew, forward vol, convexity from hedgers in an environment where dealers are unable to supply it. Who said that? Nomura's Charlie McElligott. So that was just on Monday.
And there's there's nobody left at the table but that, right? There's only a few players left at the table, right? Not the dealers, but just where do you go? What do you do? What proxies do you use? Dollar, vol, passive, gotta meet my numbers. I gotta buy something.
So this is my whole thesis of 2021 is just going to be aura of volatility, because it's like self-induced, it's reflexive, and we're just going to go bing, 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 bing. It's going to be active management all the way. They're going to wear out the passive. No, I can't say that, it's too big, but you know what I mean. It's definitely going to require active management for some, because the moves are going to be ginormous. Were they prepared for the third largest VIX move in history last week? No.
But in the comparison of where we are in the cycle and the mania and the level of price discrepancy and the level of trading ranges, is that really a big VIX? It is when you compare it to previous historical periods where it was not a huge, where things weren't as volatile. But now look at what we're doing, like from Sunday night to today. And it seems like and I thought about that to myself this weekend. It's like looking at this stuff, I don't want to look at it. And I really try to stop looking at most analogs and trying to start taking tape on a regular basis, day to day, and then sequence to sequence, because I do believe that we're in such an exacerbated state of the market structure, right? That we're doing things that are so big that things are just going to be big, and we can expect the ranges to be
instability breeds instability. And at some point, and I again to Jonathan's question, but when does it break? Who knows? I mean, this is the year I think we're going to have this tested, because of the VAR shocks, because of this, instability or fragility, because of the aura of volatility and the standard deviation moves that are going to become really outsized with a higher dollar potentially. This to me is volatility's year.
Look at 150%. Look at when they stopped allowing shorts for bank stocks in 2008, right?
Yeah, that just
market bounced after it, right? And then it just collapsed. It's never instantly when these things start happening. And you got to think about, like, with Lehman and all the rest of that stuff, it's not instantaneous. There's some shape to it, and then it goes. Like, is Melvin going to recover 53% loss? Right? What does that mean in a little?
They've dug out of holes before. I mean, they have
but
inside, it's all a price fixing thing anyway. So I'm not worried about Melvin.
But they have an impact. That story. Melvin is like, there's 10 or 15 that are associated from that tree, all down, right? Like,
how Dalio do for the month?
It's like you get licked pretty good, and you limp along because you're tough and you've had a good run and you're feeling it. But this is everybody's feeling it. Everybody wants to keep it moving, but there's a point where people are like, we've got to take what we got, and that's when the positioning totally shifts, triggers these things. So that are still sitting at the table, the only three left, and now we're kind of like we're running. Everybody's like the Fed's always got something up their sleeve.
Well,
And
the comment is good. The government can't allow the market to crash. That's the whole middle class. The Fed today gains everything off the wealth effect. And ultimately, doesn't the government have, and this is what he said, doesn't the government have to make sure this continues? Otherwise, there's the great comeuppance. The pensions will have to break their promises, and ultimately then the government will have to break its promises. So we're not.
Yes, totally in theory, right? Just say so in theory. The government would
but I don't think about
but
that.
That doesn't matter. That doesn't matter, right? Like that's not something you can.
No, I shouldn't say don't think about that. I think about that as the macro backdrop to keep, everything in its atmosphere, circling, spinning still in its orbit. But what I'm talking about is how it seems that there isn't the tail risk protection. And so when we have a tail risk event, they're not prepared for it, and it in fact just exacerbates it because they're chasing it.
We did touch on this on Saturday. The thing that does get them is what Griffin's interview was talking about last week that you shared to everybody, in the thread, is that it's not the thing they're prepared for. It's the thing that they're not prepared for that they then have to react to because it wasn't in their modeling. And then, it's last March, it was 3 weeks. It's peeled off 40 to 60% in 3 weeks. It's because they're just like, very, very ill prepared for certain situations to occur. This was something that was created internally. We created this versus existential, which is COVID. What does that mean for everybody? Nobody knows. Everybody's like risk off, right? This situation this weekend created by us doing something, kind of, crazy with the way that they're doing the trading and creating options risk and everything else with the VAR models. And it got out of hand and it's shaking. It's these things that cause people to shift gears, risk off, that then puts them in a conundrum. Can they bail? Of course, it's very obvious. Everybody knows that they need these things to stay in place because of the obligations and the fact that the system continues to run off it. That doesn't mean it won't break. And that doesn't mean it when it does break, that they still don't have options once it does break. One of the things about the municipal bonds, right, pensions, stuff like that, Fed can step in and buy those. It's bought HYG. That doesn't mean that anything's still valuable. One of the big things about this whole thing you got to think through is foreign investment in the United States. It's still coming into the United States, but if we don't show that we have our house in order and we can maintain our structure as being a good place to produce good returns, right, then that does have an impact. There's little things like this that do compound on that. Kind of government they can solve everything. They can solve everything as long as we're the place to invest. And so you got to think through that too, that is at play here. And we talked about China, and China's very much.
We talk about actual hedges for those who have portfolios, because the volatility trade is not going away, and it obviously pops up quite dramatically when tail risk enters the atmosphere. It just seems very clear that the dollar is still the hedge of choice, and volatility is the very first one, and certainly not bonds. So bonds are just not going to be.
Yeah, they're not. They're not.
The safety. So too much omnipotent control, or just really not a safe hedge. Gold, I still think with bonds, not a safe hedge. They'll have their day later. Silver and gold, we get many trillions in stimulus, then those will be fabulous. But in the meantime, they're still, debating 1.3, 1.9. It's just not moving the needle at all. So right. What do you suggest for hedges other than, adding the time? That's what I recommend, but and timing it. So I like to time it. We do that, right?
Right.
When is VIX going to rear its ugly head again and reprice everything? But it's not a trend trade. It's something that obviously has a short duration, whether it was the 35% drawdown in February, March, and then it was over. or if it was the 1-day wonder last week. The point is, it does technically trigger, and it's pretty clear to see when there is stress in the system. You can see it when the platforms start, acting funny, right? Like, look, there, what was the word you just used? Not cheesy, but the other one, when the platform started all kind of choking on Monday and Wednesday.
Yeah, oscillating, right? They're
Whatever.
oscillating. You
They
saw
were
that
just,
with, yeah, you
yeah.
saw that with UVXY and all that back in Volmageddon, like these things that hit and the systems, like they fry out, they freak out because they can't handle the actual order transactions. They have to pause, right? They have to press pause. And I think, I think that as far as like hedging, right? You got to kind of look at it in the time, what are you trying to hedge? Are you trying to hold stuff, right? Like for the long term? Are you trying to roll, right? Like you want to, are you buying and selling based on something maybe more intermediate term, like some of your stuff like that go with the flow stuff that you look at? Are you looking at like maybe when something triggers, like, and let's talk about it like in the context of your indication that you've created, right? So like volatility triggers, do you want to collar your position? So like if I'm a long-term holder, do I want to sell calls and buy puts, hold the underlying, right? So puts should protect the underlying, the calls sell, helps fund the put purchase, and I can hold on to that. I can write it down. The call sale will go to zero. If it does collapse, the call sale goes to zero. I put that in my pocket. The puts, increase in price. They offset the drawdown that I have on the actual underlying security, and then I'm back in the game, right? Like at the bottom, you can buy like that. That is a really generic way for people who want to hold something more long term, can protect stuff, really easy trade to execute. So that's one piece that you could, just one play you could make. If you're trying to hold on to it, if you're trying to pare back, you could be looking for these triggers in volatility. When they trigger, you're going to get a drawdown 2 to 3%. And you got to understand that at this point, this auction is so thin, right? Because of the way that it's structured, that you're going to get 5 points in a day, 2 days, 24, 36 hours, the way futures functions, the way the globalized trading is, that you can wake up tomorrow, be down 3%. You didn't even have a chance to hedge. So if you're trying to hedge, options over securities is solid if you're trying to hold, or you're heading into like, I don't like the derivative products as a matter of hedging. Some people use the derivative products as a matter of hedging, but I don't care for them, like the 3 times and the 2 times stuff, TQQ, SQQ stuff, because of those things being, if we're talking about a fragility in the infrastructure, we're talking about like, those ETNs got all kinds of funky language inside of them. Those are total, I call those those are the degenerate plays. Like you see those show up, and I posted this on Saturday, you see those show up getting traded with options before some people think a move's coming of one way or the other, and they'll just sell options on that stuff or call. So it's like a like napalm type thing. So I wouldn't use that stuff. So, and you look at futures.
Are there any hybrid ETFs that you track or recommend or use yourself? Because I follow our PAR, which is risk parity, and the tail, just for charting purposes. As I mentioned, we were hitting that level, and I literally am like, we're going to pause, and now we got to find out if this is actually going to be reversal with the risk parity ETF. This is how I tell that volatility is going to come in. It's one of the many ways, but for me, go ahead.
Yeah. I would say it just depends on how people are set up, right? I know people.
I know that's.
Yeah. And not in a loose way where it's like, oh, I can't tell you. I'm. What I would say is like if you want to hold equities, especially like tech stuff like FANGs and things like that, because the long term prospectus of where we're headed, that kind of thing, like probably collaring stuff, right, is really an easy thing to do. It really makes you net neutral, and it's you buy 90-day puts and you sell 30-day calls, and if it goes up on you, then the call can get hit, so be it, right? The put, you just wash them out if you want to. It's just like buying insurance. And
all right, so you're buying calendars, and you're basically just collaring long portfolios that way. Just at the way that I wanted this to be set up, just for those, because we hold on, we just put this in pre-launch mode. So real quick, on the risk indicators, because this becomes a question all the time. how to hedge or how to prepare. So I'm market timing focused. I want to look for when volatility is going to come in and then position for that, knowing that also VIX is typically whack-a-mole and it's going to go back down, base, and then, in some fashion form a bottom and then, reemerge and retest and reassert itself. But that's not how many people trade VIX, and quants certainly don't. So what I wanted to do was kind of create an indicator set, and there are 3 time frames, because we were just talking about that. It's very personal. This is a decision of, not to be blindly bullish or blindly bearish, but to actually use algorithmic trading strategies that will indicate when volatility is coming in. So for those who are chasing, those who sit in front of their computer or really want to model volatility intraday, one of the indicators is on a 30-minute time frame. So it is exactly what it sounds like. It is, chasing intraday directional moves, and it is for those who like to go in and out, or be on the right side, if you will, when they're trading. The swing, it hadn't triggered for a while, right? This was like the swing trade has been really nice in the marketplace for all kinds of reasons. But then when it does trigger, it's a nice time to tighten up trailing stops and or add some volatility hedges like puts, whether it be on the indices or on those underlying assets. But the portfolio hedger was one that I had mentioned was going to be triggering. I could see that it was about to trigger, and last week it triggered. And that's where I had said to clients, okay, I don't know how serious this is going to get, but if this stays triggered, you need to have at least 20% protection on your portfolio. And I had said that last week because I saw volatility coming in and it was going to be a big dose of it. And we had a big dose of it. And then, whack-a-mole, it came right back down. So that's why everyone's different. And 20% of someone's portfolio is a lot of hedges that would cost money unless there's a good trigger for it, right? Unless there's a good viable reason for it.
You're totally right. If you get that kind of, because once it triggers, it's going to run for a bit, right? Even if it's a correction, right? And then knowing that happens and getting that kind of clue that this is in place, right? And you had it like on Friday, it was potential. If it followed through on Monday on the more longer term one, it would have been you definitely would have broke market structure.
Absolutely.
But all the shorter intermediate term stuff totally nailed your stuff totally nailed the whole sequence of events down the whole 5-6%. And so it's like it really will depend on whether you're long-term holding for like a risk kind of management perspective. Yep. Which one do I utilize as kind of like my trigger for what I do? Because like if you're trading, that was a 6% move. It was a great move for us. Yeah. Like that move down, and then flip it back and it's okay, we're out of it. It didn't shake for risk management purposes for long term, right? So I think these are these 3 time frame things are phenomenal. And then people
I'm anxious to get them going, and other people kind of try them out. They are going to be free for a month, which is really exciting as well. So I'll be starting to tweet that out. But in the meantime, we definitely had a bounce in the indices. But I will tell you, the risk parity ETF did not bounce. And the dollar did. So I'm still looking at volatility as not going away. It'll be very playable for fast traders, and it'll be very frustrating for portfolio managers. And I think that's pretty much all there's to say about that.
Yeah, I think you're dead right. And I think it's one of those things that we are we've been saying this for 90 days. We're kind of coming. Each one of these things is another gas thing up that blows up and it's out, and then another one gas up and blows out. They blow themselves out of the game, and you're just left with a few players left in the game. And where and when did those guys run out of gas too? Or to where and when did the table reposition that those players aren't really good for business? Because you saw what they did to GameStop, and you saw what they did as their reaction. They just turned it off, changed the rules, and then crushed it. If you don't think they won't do that to the indices, right, from their seats, you're wrong, right? You're just wrong. Once it behooves large players to flip, that's it. And I've said that at length for some time now. And is that today or is that tomorrow? Hard to say. but like you saw what they did, right? They made their moves on the comeback and they just blew them out. And Melvin is not that. That's Citadel. That's Two Sigma. That's the guys that are really controlling the flow. They can move the whole thing. And Griffin said that in his interview. He said, I can move it 20% in a day, since everybody had a chance to watch it. It's words out of his mouth. I move 20% in a day. And so, you know, you need to take that and chew on it, because when they're ready with the indexes and it behooves them to no longer buy the dip, Fed or no Fed, that's when it flips. And you get these indicators. These indicators don't lie, because they show you the positional flip, and they're presented in a way that's quick to consume, and they'll be on the phone and on the web. But like they're excellent for those intermediate, very short term, intermediate term, and long term. And I've seen a lot of stuff. I've never seen it as good as this.
I'm excited to use them, but I also want to keep plowing into the actual underlying flow, because we can also see in option activity what's going on.
Absolutely.
It's so right now it's been the best tell that I have come up with, just from pattern recognition to the gamma flow, indicators aside, because that's algorithmic, but just this gamma flow has been extremely predictive for option traders. And it's definitely, it blew some folks up though too. So it's a double-edged sword.
I think you saw it today versus what it was the last few weeks, totally different. We're going to have to see if that comes back.
Yes, 100%.
People have a short memory. Maybe they come back to the table, but when they get a good beat down, right? Like this was a beat down. This was a beat down.
And you know what's interesting? The last time we had a really
public beat down.
The last time we had a really solid beat down was, it was just, I guess it was the appetizer, was that September 4th, when we dropped 14% in very quick order in the NASDAQ. And it was that gamma chasing, right? The Apple and all of that.
Mm-hmm.
That this was number 2. This was round 2. I don't know how many rounds we're going to go.
Well, we don't. What else are we going to move to, right? We've now the GameStop and stuff. That was a lot of Russell, right? And XRT.
Retail, the gamer, the retail.
Yeah. So these are small. These are small, like the small lot stocks. They're low participation. So, I have a momentum group, a bunch that we're relaunching a new version of the app. I'll go ahead and kind of put this out there for everybody. It's a new version of the app. And beta will be out available next week. You're kind of going to time with your beta test that you're running with folks, and to get free access to test it and run with it for a little while. And then, I've got a list of stocks that I'll throw in there for everybody to monitor. These are the ones we monitor for options and for kind of the momentum trade, like all this kind of stuff we're putting in. It's like, you're nailing it. The nail on the head is the game is like, what with these, because I sit there and we look at the options. This is the same set of stocks getting traded every day. Like it's not really moving very much. It's the same set of these single stock names. And, the flow of those dropped dramatically today. And then you look at, okay, if that falls off, then all eyes on the indexes themselves, the short vol trade and the passive fund. And then where are we at? What are we left with? Because if you look at and
by then Biden's 100 days will be done and his political power, we'll see. But the point is, we definitely have some legs getting cut out from underneath, but I don't think they're going to do anything too dramatic until we get through this week of big tech earnings.
Oh yeah, you see, like we're at high levels, like even with new highs, if VIX remains elevated, even if we go to new highs and VIX still doesn't, if VIX doesn't collapse and start leaking lower again, and you got to keep your eye on that, and you got to watch the dollar here. We've been saying it for a while, but look at it. It just But when it was settled on, it's settled. They got money. Dollar got bid extensively. with their yesterday was one of the strongest bid days I've seen.
And you had mentioned that the tier 1 dollar. Let's see how that the tier 1 collateral needs. Let's see if we get a lift in the dollar. But it all timed very well so far. Markets holding together very well so far. I'm going to just remind folks that on Thursday, this is exciting too. I've got Lily Frankus coming in as a Women in Trading and Finance guest interview. because not only is she a young quant female mind that is shaking up FinTwit and did a lot of work on the GameStop option flow and also silver, which, by the way, just as we discussed, it's not as much as a million piranha going after a blue whale as a lot of piranhas. In fact, a lot of whales masquerading as piranhas. It wasn't David against Goliath. It really was Goliath against Goliath. And she has kind of unearthed some of that obviousness. Like, we can assume it's retail, we can assume it's hedge funds, but she actually came up with some really good research on it. So anyway, we're going to have her on Thursday, and try not to talk too much about GameStop, but also women in finance and trading, and leveling up that space. So I think that's it. Any way you want to close it out? Because we've talked obviously about the settlement for Robinhood, and right now the hedge funds that were in trouble. Retail has been once again put to the side, and they're on their own, as they always tend to be. We're not going to anticipate what policies or SEC enforcement or market making rules are going to be changed, because it's way outside of our our ability to see. But the market right now still looks like it's, you know, a little bit too volatile. Instability breeds instability, and a higher dollar might create some disturbance. I don't have anything else I want to add. What about you?
Yeah, I would say watch potentially dollar rising, VIX rising with the market, even if it keeps leaking or going sideways. So if it goes sideways or higher, as those two things just continue to roll with it, you need to be really concerned.
Yep.
Right. Like I think that this is a tremor. This wasn't the earthquake. We've had multiple tremors now. Yep. And so, like, I think that's what I'm looking for, is what does the VIX do? Do they break it back down, or is it just hold and then continue to move higher? Even with the index, because the index's path of least resistance is up, right? Because of the passive flows for now. Is that enough without all this other stuff to keep making higher highs? Could be. But what does VIX do? What does the dollar do? I think it's as simple as that at this point. And then the option stuff, we're putting some reporting in there for the flows that we're going to drop in there when all this stuff comes out with your stuff, that we'll put in there, and that will help kind of really tune in what you're seeing with that, about like, where are these things continuing to have an impact or not. So, you know, I think buyer, be careful.
All right. Well, I'll talk to you next Tuesday. And I just sent a link if you want to sign up for early access. It's free. Try out the indicators, and would love your feedback. Thanks for, stop this share. Thank you so much for attending. And my cat is hungry and needs dinner.
Thanks, everybody.
She's very timely. All right. Have a great evening. Bye.
Bye.